you're joining in. We'll be starting very shortly. I think we're having a lot of people joining in rapidly. Maybe once we hit the 20 people mark, so we're at 15 now. Once we hit the 20 people mark, we're going to just kickstart. Yeah, so I can see some familiar names in the room already, and you're welcome. You're welcome, Dr. Shola. You're welcome, James, Funaya, Chris, Biodun. You're all welcome. Okay. Once we reach the 20 people mark, we'll kickstart. Okay, I think we've reached the 20 people mark now. Hi, everyone. Good evening. And thanks for joining this session this evening. Can someone just, unmute themselves or turn on their videos just to be sure that I'm not speaking to myself? Can everyone hear me?
Yes, we can hear you.
Amazing, amazing. So good evening, good morning or afternoon, wherever you're joining in from. My name is Jobade Jumo, and I lead the team, the innovation and entrepreneurship team here at Opolo Global. And I'm just going to be doing a short welcome before we dive right into the presentation of the masterclass. Um, this is a fundraising for early stage startups, right? Early stage founders. And we have Tofumi from Lofty Inc. here with us. But before we, go right into it, like I mentioned, I'm just going to be, speaking a little bit about what we do at Opolo Global. So we are essentially an innovation platform that enables innovators, startups, corporate organizations to build and scale high growth ventures across Africa's emerging markets, right? So we touch both the startups, we touch innovators, and also corporate organizations by supporting their growth. And we do this through different platforms. So some of the platforms that we do this through is the first one, infrastructure, right? So as a company, we have innovation hubs spread across 10 different locations in Nigeria. These are co-working spaces that enable innovation to happen, where we allow for young innovators, right? And startups to come together to work, jointly. And very interesting fact about this is that a good number of these innovation hubs are hosted in university campuses. So you can really imagine the kind of talent that we have access to. Beyond that as well, we also run innovation programs for corporate organizations. We do venture support. We, we also sit at the place where we support investment access for startups looking to raise investment. And of course, also develop the ecosystem like what we're doing right now with these events. One interesting thing right now is that we have a program currently running called the She Skills Africa program. It's an investment readiness program for female founders. And just in case you're in the room and you're a female founder and you haven't heard about this yet, I'd advise that you check the link below, the sheskills.opolo.global. I trust that the team, Emmanuel and Blessing, will go ahead to share the link in the chat box as well for everyone to, if you're a female founder or you know a female founder who is building a tech-enabled business, of course, feel free to share the link with her. So yeah, what is Opolo Collective? Opolo Collective is essentially Opolo Global's invite-only community of founders, mentors, angels, and VCs, right? So this is a space that we allow for peer-to-peer founder support, right? We do this through, both peer-to-peer learnings and also masterclass sessions like what we're having right today. We also facilitate introductions to investors, angels, and of course, giving our startups access to perks and resources, right? The point of the collective is essentially to help founders not just to build, but as well to thrive, right? It's a very lonely journey being a founder sometimes, and being in the midst of a community that understands what it is you're trying to achieve can be very helpful. I'm sure that there's a number of people here that are not a member of Opolo Collective. So what will happen is that you can either join through the link, right, that has been shared right now. The team will also share the link to join Opolo Collective in the chat box, right? And also after this masterclass session today, you would all get you will get an invite, an exclusive invite to join the collective because of course you're part of today's session. So yeah, right into today's session, we have no other person than Tofumi Idowu, right? She's a venture analyst with the Lofty Inc. team, right? And one interesting fact about Lofty Inc. is that they have portfolio companies such as the Andela, they have Move, Flutterwave, OmniBees. I'm sure these are names that most of us have heard of, right? And she has, before joining the team at Lofty Inc., Tofumi worked with the investment team at CC Hub, that's Cooperation Hub, where she played a crucial role in the Mastercard Foundation program and in both in Nigeria and in Kenya, right? So Tofumi has also worked with Mastercard consulting team in Sub-Saharan Africa, KPMG Nigeria, and also Finema, a venture building firm where she was involved in providing support to startups across Africa and Asia. She has a bachelor's degree in economics, and of course, she's also an alumni of the great OAU. So at this point in time, I'm going to just stop sharing my screen and bring up Tofumi to the stage. Tofumi, over to you. You can go ahead. Can we just, give her a round of applause just to encourage her with virtual claps?
Hi everyone, and good evening. Thank you so much, Joba,
Yeah.
for the introduction. Okay, it's really nice to be here, and I hope we're going to learn a lot today. So I'm going to be sharing my screen right now, and I think one of the best ways to learn is by actually asking questions. So I am not going to spend the whole time just talking and talking. So I'm going to go through my slides. And once I do that, briefly, then I'll try to do in 30 minutes. And once that is done, we can then open the floor for questions. Yeah, so let's get started. So just like Joba mentioned, we're going to be talking about fundraising for early stage founders, understanding the psychology of VC investors. Well, this subject is very broad and definitely not something you can learn in 30 minutes because there are just a lot of players in the ecosystem. There are lots of investors. For example, Opolo Collective, I believe, is an investor, right? Investment is not just about money. It can also be like, I don't know if you've heard of sweat equity. That's one of the things you actually get from, incubators, accelerators, venture studios, etc. So I really like to think of investment beyond money. And when Joba was reading out my profile, my first my first job in the ecosystem was with Funema, a venture building firm. And I mean, I'm really glad I started my career there because it just gives a different perspective to how startup success is not just about fundraising. In fact, it starts with you finding the right problem to solve, the best way to solve it, going to market successfully, getting your first set of customers before you then like raise funding. So a lot of the work that goes on in the background before you raise your first fund is not necessarily going to be out on the news, but it doesn't mean they matter less. So I just want to put that out there. Yeah, so let me continue. Okay. Right. So the fundraising funnel, I like to think of fundraising like a customer acquisition journey. And I mean, it is actually very easy to use this illustration because almost everyone here, we're all founders, right? So we all understand how the customer acquisition journey works. And it starts with, awareness, interest, consideration, conversion, or you could think of there are different ways you could think of it. It could be you starting with identifying your target audience, and then you're trying to make them aware of who you are, and then trying to get their interest, and then they're considering it, and then you're giving them offers that they cannot restrict their they cannot, offers they cannot offers that they just cannot help but accept. And then you convert them into customers, and then even after converting them, you have to keep engaging, keep engaging. So it's just like a typical customer journey. And the main reason why I'm taking this approach is because your customer acquisition journey cannot be done in a wishy-washy way. You can't do it without structure. You are, as a business owner, you're actually like very intentional about acquiring your customers. You're very intentional about engaging them because they're the one paying you at the end of the day. So, and I think it is very important to also view fundraising journey the same way. There is a target audience. There is a point where you actually you have to understand who those target audience are, and then who your target audience are, because like I said, there are a lot of players in the ecosystem. We're going to be looking at a few of them. There are a lot of players in the ecosystem, so, and they are not all your target audience. One thing I have actually like noticed is the fact that there seems to be in the startup space, especially in this part of the world, there seems to be a lot of, PR around VCs. A lot of things you're seeing is, oh, this company raised funding from this VC, from that VC. There's way more PR around VC than there is around venture studios. There are incubators, accelerators, grants, angel syndicates, angel groups, etc. So that kind of in your mind, when you're trying to raise funding, you're thinking VC first. And I mean, I work in VC, so this is not to say that it's not like you shouldn't raise from VC, but this is me just saying that it's not always VC, right? It's not always VC, and it starts by you actually understanding, you know, the different kind of players in the ecosystem. So I attended a program recently, and there was a conversation around fundraising in Nigeria, how VCs tend to say no a lot, blah blah blah. And then there was a particular founder that asked the question of, oh, I'm doing this, it's a hardware business, I'm producing this solar batteries or something, but I've been reaching out to VCs and they've refused to fund me. And when I spoke with the founder, I got to understand the business model of the founder, and it was clear why VCs would say no, because VCs do not fund every business, every startup, right? The VC model is not meant for every businesses, every startup. So which is why it is very important for you to know the different players, the different potential investors you can have, so that you're not, you're not focusing, you're not exerting a lot of energy on you're not exerting a lot of energy a on a particular kind of investor without getting results. Meanwhile, there are those that should actually be your target investors somewhere, and you're not reaching out to them. So that's why the fundraising journey has to start with research, especially if you're just starting out. And I believe, and why I'm taking this approach is because I know almost everyone here, I believe, are like either first-time founders, building their first startup, probably not raised before. So it actually has to start with research. Yeah, it has to start with who are actually the people that are willing to fund my kind of business, right? So it won't always be the folks in the news. It won't always be the folks that you're hearing about. So that's why you have to speak with people, either engage with people that are in the sector you're in, that have raised funding before, that have gone ahead of you. They are much more likely to enlighten you on the kind of investors you should actually be targeting, the ones you should not talk to, because they can't just fund you because it's not part of the thesis. So that's why it actually has to start with, I call it identifying your target audience, quote and unquote. And we're going to be talking a lot about that. And yeah, so like I said, raising capital is a strategic process. It's not a one-time event. So you have to see it in a way, like just the way you see it, the way you acquire your customers. And it also requires dedicated time and resources, often occupying a founder's full attention for months. So you also have to like be strategically prepared to go into into the market to fundraise. Because, okay, let's say it in plain terms. Before someone you do not know, like for example, someone you do not know comes to you, let's forget business now. Someone you do not know comes to you personally and asks you to give them money because they believe that they can double that money for you. You don't know them. You don't understand the business they're proposing to you. Personally, you'll be reluctant, right? You will want to do your due diligence. You want to be sure to a reasonable extent before you can give them the money. You will want to build some certain level of trust before you can give them money. So, like, just look at it that way. Like, if it were me, if it were my money personally, what would I do before I actually hand money over to this person? So, and that is why the fundraising journey is almost always a long one. Yes, there has been precedence of, fast checks, short fundraising journey in the past, maybe in the past like 5, 10 years when the ecosystem was still very young. But still young by the way, but like the early days when the momentum was so high there, a lot of people were so excited, and then there was really no structure. People were just like trying to get into this. I mean in Africa, obviously. They're just trying to get into this, just trying to, get a hang of it. So there of course has been precedence of you raising funding like 1 week, in like 2 weeks, and then you hear things like, oh, you just sign a safe note and then you're good, blah, blah, blah. Well, I say unfortunately, I think fortunately, the face is actually like, it's almost gone because now there are structures in place. There has been, um, there's been lessons, both good and bad ones. So due diligence is more stringent. Things are more structured. We now are VCs in Africa now have more of institutional investors. In the past, a lot of VC companies, their first fund was probably from, angel investors, corporate executives, mostly from folks like that. But now the VCs are getting money from institutional investors, foreign capital. So this then warrants putting structures in place, which of course would make the fundraising journey longer. So it is very important to put this at the back of your mind before you kickstart and make sure that while you're chasing the money, you're not losing sight of your business and the business is not suffering for it. And which is why a lot of times it's encouraged to have to not be the only key man in the business, and if you're not around, everything crumbles. Yeah, so that is it for this. So let's move on. So yeah, like I said, know your target audience. So I want to, there are a lot of concepts in this world, but one concept I really love personally is the Pareto principle. And it's something I apply in every aspect of my life, personally, professionally, because I think it's a very powerful principle. And if you think about it deeply, you would actually, you would see why I think it's a very powerful principle. 20% effort yields 80% results. That's what Pareto principle means. So let's use a very simple example. Let's say if you've ever written an exam, I believe almost everyone here should have written an exam before. You have a curriculum, right, that you're supposed to read, prepare for the exam. There is no way the exam is going to cover every single thing in your notes or your textbook, right? It is, even if you read the old textbook, the questions are going to be based on just the part of the textbook, right? That's just a very simple example. And it's just saying that it doesn't mean you shouldn't put 100% effort, but at the end of the day, 80% of the results you're going to get is going to come from 20% effort, right? It's just, again, let me make reference to customer acquisition. It's just the way there's this I believe everyone should know what the customer funnel is. And you target maybe 1,000 people, and then 1,000 people move to the next stage. Maybe you run an ad on Instagram, you reach 1,000 potential customers, 100 of them end up downloading your app, 70% end up signing up, the 30% end up paying, and maybe 10% end up paying again, like becoming like second time customers. So you can see like that funnel, it just keeps getting narrower and narrower. So it's just like that. So when it comes to fundraising, you're going to speak to a lot of people. You won't get yes. It's very difficult to get to a yes, especially the first yes, right? So it's important to put that at the back of your mind, and that would actually help you target your efforts. And that's why it's not advisable to just sprinkle your efforts all around different kinds of investors, rather than targeting the ones that actually would most likely convert to investors. So finding this 20% effort is going to stem from research and understanding the landscape, like I said. And it's important for you to ask yourself, what stage is my business in, and who are the kind of investors that are looking to invest in businesses like mine? Okay, so yeah, let's know your target audience. Like I said, let's start with friends and family, right? This group should I call them group of investors? They're often overlooked, and in the real sense of it, the important group of investors, they're not investors per se, but they can be investors, right? So when you're just starting out, you only have an idea. Not everyone is going to have the luxury of having friends and families that are willing to believe in them and willing to put in money, right, in their vision. And when you say friends and family, it doesn't have to be like close friends. For example, let me give an example. You have been working in, let's say, what industry now? Let's say DevOps space. Let's just say DevOps for like 10 years. And then after 10 years, over the course of the 10 years, you've had colleagues that you've grown together, they've grown, they know the kind of person you are. And then after 10 years, you decided to leave 9 to 5, and then you decided to start your business, right? And then you have these people that have seen you work over 5 to 10 years. So they know you, they know the kind of person you are, they know your capabilities. You don't have to say so much to convince them. And then you have this brilliant idea. They should actually be the first set of people you should speak with. First set of people you should actually try to convince to invest in the business, right? So it's it's a group that we should actually normalize as first time founders and people that are just starting out, especially if they don't have a lot of traction. It's a group we should normalize reaching out to, because it is faster engaging them than engaging somebody that doesn't know you at all, or a group of other investors that do not know you at all. And you don't want to, we all know the whole principle of starting. You have an idea, you quickly come up with an MVP, and then you have to test, measure, iterate. So like you can't afford spending the first 6 months looking for investors before you're now able to test, and before that you're probably already tired. So it's first set of groups that should actually not be overlooked, right? And then we have angel investors. So in angel investors, these are individuals, right? But why they're separated is because angel investors are, I would say, are intentional investors, right? These friends and families that you're reaching out to, they're like former co-workers, former neighbors, former, cousin, uncle. So they're not necessarily in their mind. They don't have it in them to want to be an investor in a business. But angel investors, I would say, are individuals intentional about becoming investors in businesses, promising in businesses. And one thing about angel investors is because they're individuals, so they run by individual philosophy, individual beliefs. So there are different angel investors invest for various reasons. You could see like angel investors that, I mean, corporate executives, for example, they are looking to, invest in the next big idea in the industry they work in. So they're not necessarily looking at investing outside the industry they work in, which makes sense because they better understand the industry they're in. There are angel investors that are more impact oriented. So they are, and impact investors are not investors that do not care about profits. It just means that the impact investors, they care about impact as well. So it doesn't mean they do not care about the return. And I think that's where a lot of people tend to misunderstand. So their motivation is always a mix of financial return and a personal desire to support founders they believe in. And that is why they would always be the next set of investors after friends and family to actually reach out to and convince to invest in your business when you're just starting out. Okay, and aside from just investments, a lot of times they are very, very valuable people to have on board because a lot of times angel investors they can give so much credibility to your business because they are mostly people that have, gained a lot of identity capital that if they end up investing in your business can rub off on your business. And then when you're presenting to other investors, you're saying, I have this person on board and you don't have to say too much. So that is also like very important to note. And that thing is you can get way more than money, way more than connection. You can get, the mentorship, especially the mentorship, the structure. A lot of angel investors, they have like years of experience, which have helped them in acquiring their wealth. So these are people you do not just want to collect money from. And then of course angel investors are mostly active investors, right? So it is also important to take advantage of the expertise, the advice, the network, see. Then we have angel syndicates and angel groups. So these are basically groups of angel investors. So because angel investors are individuals, most times they have what major things that they're engaged in. So they're not like VCs who actively go out there to actually source for startups. So a lot of times angel investors are investing in deals that come their way, people they know personally, people that are introduced to them by someone they trust, etc. So that angel syndicates and angel groups are created to be like, it's just like the way here we're community of founders. It just sees as a community of angel investors. So for example, we have different angel groups. There is Rising Tide Africa. That's like it's an angel group with only female angel investors in, I think, Africa. There is Lagos Angel Network, there's Afropreneurs Angel Group. There are different angel groups. So it is even easier to, it's more it's more efficient to reach out to angel groups because you present at once and then you're presenting to a group of investors all at once instead of reaching out to each and every person one after the other. And then we have venture studios, accelerators, and incubators. These three groups of investors are very different. I just put them together. So because I mean the essence of this is not really to break this down so granular in a very granular way. So venture studios, we have accelerators, we have incubators. The way I like to think about it is, one thing about terminologies is it's very subject to interpretation. So, but it's always good to understand what it means from an eye level perspective. So we have incubators. Incubators are typically looking for very early stage businesses, um, businesses very early stage founders actually, because a lot of times businesses that get into incubation programs are not even fully formed yet. They probably have just an MVP. They probably don't even have their first customer yet. And just like the name implies, it's like incubator. Like it's supposed to be where a closed knit place where you actually like grow internally before you then boom, right? So and then there are the accelerators. Accelerators are for businesses that you have your MVP, you've been able to you've already achieved proof of concept. You know that what you're building already works, and then you just need that push out of your shell. Something you just push you out there. So accelerators. So venture studios are like more hands-on. Venture studios have, think of what's the name? Mm, skip my mind. But anyway, venture studios, they are more, they are, they, I like to think that venture studios have more human resources, right? Because in venture studios, you have talents, like more than most times for incubation and for incubators and accelerators, you have access to mentors and tools and network and systems that have proven to work over time. All those things are also present in venture studios, but there is more. You have access to talents, and there is actually more hand holding. At least that's how venture studios is supposed to be, right? And venture studios they are more like co-owners rather than mentors. They're more like co-owners. So that's like the small difference between these three group of investors. And sometimes incubators do not give funding, and sometimes they do. But most accelerators and venture studios actually also like there is funding involved in the program. Some provide the funding at entry, some provide it in tranches, some provide it after you must have hit some certain milestones, or some provide it at the end of the program. So it depends on the on the company. Now to the VCs. VCs are primarily focused on generating a massive return on investment for their limited partners. So the way the VC business model works is there are limited partners, and limited partners are also investors, right? They're just mostly institutional investors, but they can also be individual investors. So VCs basically creates like a fund, and then they invite limited partners to invest in the fund. So VCs also have investors, right? And these VC funds have dedicated theses. So it can be sector focused, it can be stage focused, it can be it can have like some other focus as well. So a lot of times you can see VCs that are sector agnostic. It means that they can invest in any sector, but it doesn't mean that they can invest in all businesses, right? They're probably there are some that are focusing on pre-seed and seed. There are some focusing on seed and seed extensions like Series A, some focusing on Series A and Series B. So they have like thesis. There are some that are focusing on just one country or just a few countries in Africa, or a lot of countries, or all the countries in Africa, or even beyond Africa. So that's why it is very important to make research to know before you reach out to a VC. Actually, a lot of VCs have their investment is on their website, and even if you don't see it on their website, VCs are actually always open to, you can reach out to anybody in working in a VC firm, and then they'll tell you their investment thesis. They're always open to talk about investment thesis, because everyone, we all want to optimize for efficiency, right? So it's very important to know the thesis of a venture capital firm before you reach out. so in order not to, be disappointed, in order not to spend so much time on chasing something that would most likely not yield results. So the VC business model is looking for businesses that have the potential to scale quickly and achieve a significant exit. That's the business model. And there are there are some VC firms that are also like impact oriented as well. There are some VC firms that are probably like focusing on specific sectors. You can see like climate funds that are just looking to invest in, climate businesses in the climate industry. There are there are funds that are probably just focusing on AI. There are funds that are just focusing on enterprise software. So there are different funds like that. Although we do not have a lot of dedicated funds like that in Africa yet, because we're still compared to the Silicon Valley, US and co. We are still like a relatively young ecosystem. So you won't see a lot of those funds as you would see in the US, for example. So a lot of VC firms are still like sector agnostic, looking at different sectors. And that's why a lot of times it's so competitive, because there is limited capital, but there are a lot of businesses out there looking for funding. And of course, we have the PE firms. I won't talk too much about PE because they come at the later stage of the business cycle. So PE firms typically come post Series A, Series B, Series C. And then we have the DFIs. I particularly added this one because DFIs, if you look at quite a number of VC firms that have raised or announced funding recently, and you read the press release, you would see that a lot of the investors in these VC firms are DFIs. They are developing finance institutions, and these DFIs are majorly, public or semi-public entities. So, and they have this dual mandate of generating both financial return and creating a positive development impact. And that is why a lot of VC firms are raising from them, because when we think about it, a lot of there is still there's still that gap, or that conviction gap, when it comes to bringing in commercial capital into Africa. For example, if a VC fund in the US is trying to raise, they could raise from a pension fund, they could raise from a corporate like Meta, Amazon, and co. But we don't have that much conviction yet in Africa. So a lot of VC funds are raising from DFIs. Now, why I'm bringing this up is because DFIs are also like investing directly in startups as well. So a lot of times when DFIs invest in VC funds, one thing they are also looking to do is to also invest in the startups that the VC funds are investing in. So it doesn't necessarily have to be the startups the VC funds are investing in. So they're also looking to invest directly in startups. But because they do not, a lot of these DFIs are like, they're probably foreign, or they could be like a DFI in North Africa, for example, looking to invest in West Africa. And it just makes sense for them to invest in a VC fund that is in Nigeria, for example, because the VC fund will understand the landscape better. But they are also looking to invest in startups in Nigeria, for example. So this I think it is just why I did is because I think it's very important to have that at the back of our mind while you go on the fundraising journey. It may not be at the pre-seed stage, it could be at the seed extension, Series A stage, but it's just important to have it at the back of our mind. And another thing is there are DFIs are also they're not just looking at equity investments, they're also looking at debt investments as well. So a DFI in Nigeria is Bank of Industry, right? So Bank of Industry is known for more of debt investment, right? So debt capital into businesses. So you can also like look at those those DFIs as well. So that's about the different kind of investors. So I just so this is a table that just shows you the different, those group of investors that you should actually probably be speaking with at every stage of your at every stage of your business, idea, pre-seed, seed, pre-series, etc. And now I would like to say this, right? If we look at the evolution of the ecosystem, right? If you think back or in 2025, like 10 years ago, VC funds are actually established 10 years ago in Nigeria, for example, in one of the big four, Nigeria, South Africa, Kenya, and Egypt. So what you would notice is that there has been an evolution in the kind of startups that they invested in, right? And this is an hypothesis I have. VC funds are raising for the need that actually exists in the market. So let me give you an example. If you think back, 7, 10 years ago, VC funds, a lot of VC funds that we know today are just, starting out. And the startup ecosystem is also like just, becoming well known. And so a lot of businesses are just starting, right? So then at the time, you would see a lot of VC firms actually investing even idea stage businesses, pre-seed stage businesses that maybe have a prototype, then have an MVP, or don't even have a paying customer yet, right? But then afterwards, you see that the VC firm will then raise another fund. I mean, if you like retrospectively, raise another fund, and then they are now saying, okay, when you're investing in pre-seed, you have to have some form of traction, right? And then you see that VC firm raise another fund, and they're like, oh, you have to be making up till 500K ARR for us to consider an investment in you. And the main reason is because as the ecosystem is evolving, the VC business model also has to evolve with it, right? Because when VCs invested in, let's say 5 years ago, businesses that were invested in 5 years ago, in the idea and pre-seed stage, they then get to a point where they need more capital to scale. But by the time they get to that point, the VC firms that invested in them, they've exhausted the fund that they raised, right? And because we do not, at the time, we didn't have a lot of, VC firms. And when I keep saying we don't have a lot of VC firms, I'm comparing it to more advanced ecosystems, right? I'm talking in relative terms. So it was very difficult for these businesses to raise funding to take them to the next stage. So I'm talking Series A, Series B, right? And that's why VC firms now started raising for that stage to ensure that those businesses that were funded in the idea and pre-seed stage do not die because they do not have the capital to move them from seed to Series A, right? And then the idea and pre-seed stage now seems like VCs are saying no a lot to idea and pre-seed stage businesses because in that space we have the angel investors, we have the angel syndicates, and that has also been growing. So that's why it is actually important to make research, try to network, ask questions to find the right set of investors to be speaking with at each stage, right? So that's why if you see here in the idea stage, our family and friends, angel syndicates, and venture studios. And then when I say venture studios, incubators, and accelerators. Same for pre-seed, and then I added VCs as an afterthought, but of course at the end. But from seed, you can then see VCs like actively involved, right? Seed, pre-series A, Series A, Series B, and then Series C, you have Ps and DFIs. Now, one thing I would like to mention, and I think I would mention it in this slide. Let me jump to this slide. One thing I'd like to mention is, as much as I keep emphasizing that for each stage, you need to, target your effort and, speak with investors that are actually looking for the kind of business you're building. I would also like to mention that it doesn't mean you should completely ignore the other group of investors. You're not actively seeking them out, but as you attend events, as you engage in the ecosystem, you would meet them. And let's be, there is a place of relationship, right? There is a place of building relationship when it comes to fundraising. So if an investors, or let me just say VC, a VC's no today can turn to a yes in your next round. So no today doesn't mean no forever. I want to maintain that relationship to make sure that once you're raising your next round and you're reaching out, you're not starting from ground zero. So the aim is that as you proceed, the fundraising journey gets easier. So, and that is why I added this slide to say that you should manage fundraising like you're managing a project, because it really is a project. It should actually go without saying that you say you're fundraising. How are you tracking your fundraising efforts, right? Do you have just a simple spreadsheet? These are the investors I have spoken to so far about my business. This is their contact. This is what they said. This is the status of our conversation. So that your next round, once you close this one, your next round, that could be your starting point, right? And then go back. Oh, these were the people I spoke to. This was why they said no, right? And I think I've already gotten to a level where I should actually reach out to them. I think I now have what they're looking for, right? And I mean, you don't even have to wait till your next fundraising. You can actively send out investor updates. You can, even after closing a particular round, or even before closing a particular round, as you're still fundraising, you're sending updates, you're building that momentum for the future. That's when I say that. And then yeah. So this is the next slide. It's not you, is the deal inside the investor's head. And I think I've spoken a lot about this already, that when you get a no, it's often a reflection of the deal, it's often a reflection of the deal not fitting the fund's mandate, not a reflection of your business quality. A lot of things because I speak with a lot of, founders, especially when I go for events, mixers, etc. And there has to be an understanding that when a VC or an investor says no, a lot of times it's probably not because your business is not good, right? It might just be that it doesn't fit the mandate, doesn't fit what you're looking for, right? And it is the sooner you accept that, the better it is. It helps you to move forward to the next person as fast as possible and know when to try to convince and know when to move forward. So if clearly it's because it doesn't fit the mandate, then don't try to convince, because the mandate is the mandate, and it is actually important. And I already mentioned this, VCs have their own investors to answer to, so it means that they have strict criteria to follow, and that is why the fundraising journey would most likely take a while. It's going to take long. It's not going to take 1 week to 2 weeks. It will probably take months a lot of times, because you're dealing with different investors with different criteria, so it depends on the journey. And that is why when you're just starting out, idea precede. When you actually need to iterate fast, it's better to raise from friends and families, angel groups, etc., before going to VCs. Yeah, I think I have mostly mentioned this. So the VC process, navigating the ladder to a check. So now I am moving on to, okay, let's say you're raising from VCs. This is typically what it's going to take. There's initial intro meeting. Usually you meet with an analyst or an associate to have a high level understanding of the business and assessing the thesis fit. And I know that it can be, how do I say? It can be, what word should I use? It can be tiring. Yeah, it can be tiring to explain your business multiple times. And especially when it seems like the person is not getting it the way you're getting it. I think I get it, right? Especially when it feels like it's because you're the founder, right? You're supposed to know the business more than any other person. So it can be tiring when you keep explaining and it feels like this person is not getting it. Yeah, it will happen, right? Especially if you're building something that is not so straightforward, you actually have to convince. And I think that's why there's a need to be very patient, right? Especially if you're speaking with VCs that are sector agnostic. It means that there is no way they are. I mean, they'll be experts in some sectors that they have experience in investing in the past. But if it's a new sector that they've never invested in, then they are going to have a lot of questions to convince them. And that's why you have to and that's why you have to understand the business the most, because it is your business. The expectation is that you understand the business the most, the market the most. Like there's no better person to learn about your business and your market except from you, right? And that's why these initial meetings is always very important, because and then let me just put it together: intro meeting and business deep dive. That's where the visitor actually try to understand different aspects of your business. What problem really are you trying to solve? How big is it? What's the solution? How does it work? How much do your customers pay? What's the unit economics? How many people do you need to skill? After you do this, what is next? A lot of questions, just to know this is the right investment. And when you're going through the process, it is important, what I said in the beginning when I started, it is important to know that before you can give out your money, you also will want to know these things, right? And that would actually help you to be more patient and be more receptive, right? Um, yeah, so after the whole business deep dive, then there is investment committee. I won't go into the nitty-gritty because I think, yeah, the investment committee where the final approval is given, and then there's due diligence, depending on the stage of the business, depending if the VC is leading. So a lead investor is most times the first investor to say yes, but not necessarily. But most times the investor to Okay, just like leader and follower, right? So there are VCs that are capable of leading because they either have more resources or they have more expertise. And when an investor is leading a round, it means that they are they are the ones that are going to do a lot of the groundwork. So if, let's say, for example, you're speaking with an investor in South Africa, it means that they'll probably travel down to Nigeria to meet with you, to meet with your team. If you have a physical space, if you're running a business that requires a physical space, they want to see it, all those things. So it's the lead investor that will typically do that. The lead investor will typically do the financial due diligence, maybe consult a third party to do the financial DD, consult a third party to do the tech due diligence to see, is this tech really strong? Can it really build what this founder is saying it's going to build? All those things. And once a lead investor does that, every other investor follows suit. So a lot of times, let's for example, you're raising $2 million and you have 5 investors. All the 5 investors will not do that. It's just that lead investor that's going to do that. Set the terms and everything, and every other person follows. So that's what I'm saying. The process is not a one size fits all. For a lead investor, it can take like 4 months, 5 months, 3 months, right? But for investors that are not leading, you already have a lead in place that have done all the groundwork for them. You can take like 1 month to get to a yes, 3 weeks, 2 months to get to a yes. So depending on it's not a one size fits all anyway. And then there's deal negotiation, closing. You negotiate on different things. You negotiate on different things like the valuation. You negotiate on the valuation. You negotiate on board seats, etc. So, yes. So I'm almost done. So we can open the floor for questions.
Amazing.
I think I already
I think
mentioned.
you can just breeze through the remaining parts
Yeah.
while we take questions. Yeah, I think so.
Yeah. So then we have, I already mentioned this, right? Oh, did I? Anyway, the ROI of your idea, what investors really want is the return on investment, honestly. So especially now speaking for VCs, uh, the return on investment is important, right? So, and if you look at this Venn diagram, does the problem exist? Is the solution viable? And is it commercially viable? How easy is it to scale? How easy is it to get to, 500K revenue, 1 million revenue? How easy, how fast, how long? Those questions, very important. And then if these three are in place, it's actually the sweet spot. The problem obviously exists. A lot of people are facing the problem. A lot of businesses are facing the problem. The solution is viable. It's like just the perfect solution for the problem. And the solution is scalable or commercially viable, as the case may be. So final slide, master your pitch, the art of storytelling. I already mentioned a bit about this. When you're pitching, clarity over jargon. I know that you're going to, because you are the the master. You're meant to be the master in the industry that you're playing in. So you might be tempted to speak like you're speaking to a fellow master. But honestly, the trick is in the simplicity, how simple you can explain it and how easy you can explain it. So clarity over jargon. Tell a story, a compelling narrative. And that's why it's always important to understand the investor you're reaching out to before you reach out to them, because it helps you craft a story that resonates with them. So you will not necessarily tell the same story to everyone. Do your homework, mention that, own your market, know your market better than your investor. The goal is not to sound smart, but to be understood by the person you're speaking with. So that being said, thank you. And I think I'll open the floor for questions.
Wow, amazing. That was very, very, very comprehensive too for me. Quick question, do we get a certificate for attending this? Because I mean, this was an entire this was an entire university course, to be very honest, right? A professional course. And I hope everyone got as much value that from listening to you. I know there are a couple of questions already in the chat box. Right. And but before we go right into those questions, I have a few from my own end, right, that I just thought to also, ask, right? And I think it was good that you put out that slide that explained what kind of investor should a startup be looking out to reach out to, rather, right? Considering the stage that they are. So, for example, where you have the idea stage startup, they go to an angel investor. Where you have a Series A startup that has already gotten a PMF already, they would move to the exactly the VCs and the Ps and the DFIs. So I mean, I think this is a very, very interesting or very, very important slide that helps everyone to sort of understand how they should approach targeting, right? But a quick question I just wanted to ask you, right, before we go into the questions in the chat. Because you mentioned something about managing relationships, right, with investors, whether or not they're at your stage or they're the ideal investors for you at a particular stage that you are. My question would be then, and how do you then balance out sending out updates to investors versus overwhelming their inbox, right? Overwhelming their DMs, for example. I mean, you want to show that, oh, you're progressing. You want to show that you're doing so well. Even though they're not your investor at this point in time, you're just sharing updates. How do you balance that with being perceived as as a nuisance? Especially for the
Okay,
startup that was growing really fast, that every single week is having updates. That, oh, I just hit 1,000 users today. Oh, I just hit 2,000 users tomorrow. And it's just telling the VC almost every week. Like, that can get tiring, if you know what I mean.
yeah, that can get tiring.
Yeah.
So so let me approach it this way. Even portfolio companies,
Mm.
we don't get updates every week, right? So I think the most the most frequent is monthly. Like that's the most frequent. It's
Mm.
monthly.
Mm.
In fact, some investors will even request for quarterly.
Totally.
So it's because the days actually go by fast, like very fast, unless something huge, like
Mm.
so huge out of the world happens,
Mm.
right? So and so of course weekly is very is a lot. And but I want to put it out there that I from what I've seen, investors are actually very open to updates. Because at
Mm.
the end of the day, the money is there to be invested.
Yeah.
And investors are actively looking for the next best deal to invest in. So no matter how many times they say no, it doesn't mean that the money is not doing it. Like it won't
Mm.
do anything where it is. It has to be
Mm.
invested to return.
Mm.
So investors are very open to updates. You just need to know how to approach it. And that's why I just said, even portfolio companies,
Don't
the
you?
most frequent is monthly.
Mm.
So if you can do it quarterly, have a mailing list. I personally, when I speak with founders, I say is that send me updates because I'm actually interested because it is the idea stage company today that will most likely end up becoming the seed stage company of tomorrow.
Cool.
It's a
Cool.
business that just as start and boom, Series
Mm.
A. It's
Mm.
those businesses that will end up growing to that point. So I'm actually interested in the journey. So that once you get to that point, I'm one of the first set of people to say, "Oh, hi, are you looking for money?"
Mm.
So I'm actually interested in the updates, and
Mm.
I always say that I may not respond, but it doesn't mean I'm not reading it. In fact, when I get updates, at least personally, and I know some of my colleagues that also do that. When I get updates, I tag them. I won't read them immediately, and then maybe end of the week, end of the month, I just go through all of them at once. Okay, how is this one? How is this one? And then I may not answer, but I'm seeing it,
Mm.
right?
Interesting.
So it shouldn't be discouraging that I keep
Mm.
saying that updates, nobody is saying anything
Mm.
because they get a lot of updates and they can't respond to everything, but it doesn't mean they're not saying it.
Imagine
So
having to respond to every update, every single company that share you an update. That would be very overwhelming. I think
yeah,
just to put in it, I think I learned this from an ecosystem leader some time back. He said that when you want to share out updates to investors, follow the ACTA framework, ACTA framework, which when you're sending your email, you include, and this is to the founders out there, the early stage founders out there, you share your achievements, you share your challenges, you share the target and what are you asking for achievement, challenges, right? Your targets for the next quarter or the next sprint, and then your final asks. That's the ACTA framework. So, I
yeah.
mean, you can always follow that. So, let's go into the questions in the chat box right now. Corey Day is asking, what is the typical MRR at a pre-seed stage?
Hmm. The typical MRR at the pre-seed stage.
Mm. It's a very, very interesting question. I think
It's
it's relative. Every company has
it
their
is
own.
very relative. Yeah, that's what I'm saying. Yeah, it's actually very relative.
Very.
And it is, and that's why, and again, I'll say it again, research, right? So I think what I would just advise is for you to check investors that are actually looking to invest in pre-seed and actually ask them what
Mm.
they're looking for. For example, I know that we are looking more for seed extension series A,
Mm.
and we're looking more like at least $500,000 ARR.
Mm.
So there can be other investors that will do seed at 200K ARR. So
Mm.
it depends on the mandate and
Mm.
the thesis, but typically pre-seed you must be making some form of traction already. So it could be it,
Very.
and some investors could be comfortable with 10,000 MRR.
Mm.
Some could say it's 25,000 MRR. So it really depends. So it's
Mm.
not a one size fits all.
It's amazing. I hope that answers your question, Corey. So I'll go on to
And
this
let me
question.
say that it's also dependent on sector sometimes as well.
Mm.
So there are some sectors that have more like delayed gratification. So it's
Mhm.
understandable if you don't have a lot of traction,
Mhm.
but there are some sectors that it's expected that you should. So
You should
it's
have.
very, very
Mm. Very true. So yeah, is asking, how do you recommend that we educate family and friends investors who may not be familiar with how startup investment works? For example, when they might expect to own 50% of the company for a small amount. Very interesting question.
Yeah, it is actually, and it's a problem,
Yeah.
right, in this part of the world because it's a problem. Yeah, honestly, I and that was why if you look at the example I gave, I didn't give an example of family, honestly. The example I gave was more like people that you've worked with professionally, you've built that trust with them already,
Mhm.
and it is easy for you to explain to them and they would understand. For
Yeah.
example, I cannot start a business and I'm trying to understand to my dad why should he they would not understand. So, so I think it's better to target people that are actually easy to to educate and you understand your relationship with them better. So I really cannot, I can't explain that for you. But
Mhm.
it's for you to know that okay, these are the people I have in my circle. And if I reach out to this person, this is what this person is going to ask me. And the kind of question they also ask, you also have to look at their capabilities,
Mhm.
right? You're reaching out to them, they probably don't have the money, right?
Mm.
And the little they have, you're asking them to give you. So of course they will ask you seemingly ridiculous questions because it's money. So it depends as well on the people you have in your circle.
Mm.
And yeah, not everyone would have the luxury to, to have family and friends invest.
Interesting. I think I would just add that it might be helpful for founders who are at that stage to focus on getting actual angel investors or angel groups, right? Focus on those ones. Don't even bother yourself with family members at all. They probably wouldn't even understand what it means. So they'll be the most wrong people to even get investment from. Someone is okay. I see that there are a lot of questions around how to get the slides. Tofumi, I'm very sure she'll be very magnanimous to share the slides with us after this session, right? But I mean, you have to be a member of the community. I'm sure everyone here has gotten the link. You can always just join to request access, and then you'll be added. The next question we have here from Olabode Martins. It says, after the research phase, what is the traditional way of reaching out to them? Cold email, IG. I'm going to add one more question to this, just as a follow-on from what he's saying. Are you what's the best approach? Is it for you? Would you prefer warm intros or cold emailing? Just as a drop out of that question. So, did you get the question? Should I say it again, Tofumi?
I understand. I get it.
Cool.
Um, so I'm going to say that anyway works. Anyway works. And one reason why I say that is a lot of people might think, okay, cold emailing doesn't work because they don't get responses. And I just want to put it out there that a lot of people are sending cold emails, right? But there's actually a high chance that the email is going to be read if you're sending it to the right person. Now, let me show you something. I think there's a part of my slide that I actually did not mention. I didn't emphasize. Uh, Let me see. So I wrote here that keynote, while a partner's buy-in is important, they will still pass the deal to the junior team for due diligence. Network horizontally with analysts and associates as well. Their conviction is what drives the internal memo and determines whether the deal gets presented successfully. A partner can open the door, but the analyst or associate is often the key holder. So a lot of people, which I understand, you want to reach out to a VC firm, you go on LinkedIn, you're looking for the person that holds the highest position in the company. That person is
Vacancy.
the busiest. Is the busiest. And that person is most likely the least person to
Yeah.
reach, like the is the most likely the wrongest person to reach out to, right? Because they have a lot of things they're doing. And let me just tell you, they will get forwarded to analysts and
Mm-hmm.
associates.
Absolutely.
If they see it, they will get forwarded, right? So why not just reach out directly to those analysts? And for example, I may take a long time to respond to my LinkedIn messages because I get a lot, but I actually intentionally look at them because I get a lot of founders reach out to me on LinkedIn. And because I am actually looking for, because that's like one key part of the job, to actually look for these businesses. So I think when you're trying to do this cold emailing, cold chat on LinkedIn, you don't necessarily have to reach out to the managing partner or the general partner. Actually, reach out to the analysts, reach out to the associates. Like, those people are more prone to respond to you. And the truth is that if the business fits the thesis, they will push it forward because the money is there to be invested.
Yeah.
So that's one thing I'd like to say. So cold email, it's dependent on the person you're reaching out to. But of course, an intro it goes way like a long way than a cold email, a warm intro. So if you're able to get somebody that knows me to introduce you to me, even if it doesn't really fit the thesis, out of respect for the person, I might want to take a call. And that call could lead to more conviction, right?
Mhm.
Rather than if the pitch deck just lands in my inbox and all the information I have to make a decision is 5 to 10 slides.
Mhm.
So a warm intro. So go out to events, go out to mixers. There are a lot of mixers happening. Lagos that I know. I don't know about other states, but I know in Lagos, a lot of mixers, a lot of ecosystem events actually happen. Go out and speak with people there and you can actually like get their attention and speak to them. So yeah.
Amazing. I mean, here at Opolo as well, that's what we're doing in this collective, Opolo Collective, right? The purpose of this is to enable ecosystem engagement. And I mean, you don't know if Blessing here on the call or someone else here on the call might be the key to your next investor introduction. So that's why you must join the collective, right? And quick one about what you said too for me, I think was quite interesting. Nigerians are very funny, right? Where's your Oga? Who's your Oga? I want to see the Oga. It's not you I want to talk to. I don't care who you are. And that mentality, you need to really change it, right? Because like you mentioned, they wouldn't have the time to actually pass or to even review the deal or review
Go
the
forward.
pitch deck. Exactly, they're definitely forward. They say is asking that how much ARR. Okay, I think you already answered that kind of question, so I think
Yeah.
we can ask from that question. Then Dr. Shola is asking that what common mistakes do you see founders make on their cap table?
Uh,
Very,
okay.
very
Cap
interesting
table.
question. That's from an experienced person. You understand that question.
Yeah. So giving too much too early, definitely. Um, it's a trap that a lot of founders tend to fall into. And honestly, I understand because when you're just starting, you're very desperate. You're like, I just need this thing to to go off the ground. But it's a trap that you should actually try so hard not to fall into. And sometimes it's always out of ignorance as well. And one thing I would actually like to recommend is to model a cap table. Before you say yes to giving out a percentage to an investor, actually model it out and see how it's going to affect you in the next round. So let's say you're raising pre-seed now and you're diluting your ownership by 20% already. If you're raising seed, you'll get more diluted. Series A, Series B, it's a long journey to give out too much too early. And that is why safe notes, convertible notes, they are always like good tools. But at the same time, they are not just something you're just supposed to, plug and play. You also have to be very careful when you are, because you at the end of the day you have to make the decision of the valuation cap. So there are decisions to be made for safe notes as well. So and when they end up converting, when you raise a priced round, it's still going to dilute. I've seen different situations whereby I mean we would be skeptical about investing in a business because we feel like after we invest, the founder will be too diluted and we'll be worried that what exactly is the incentive to stay in the business? Because if you've built a business for 5 to 10 years, and then at the end of the day you're just owning barely 5%, it means that if one problem comes up tomorrow, there's really nothing holding you together. So, so it's actually like it's very, very important. And the kind of people you have on the cap table is also important. I think just the way investors do due diligence of founders, I think founders should also do due diligence on investors. And it is actually very important. I get the whole you really want to raise funding, but you also want to know who this investor is. It is actually very important. You want to know, and the best way to know the kind of investor an investor is by reaching out to people that they've invested in the past and actually ask them, what kind of investor is this person or is this company, right? Different investors have reputation. It might not be online, it might not be in the public, and that's why it's called due diligence. So you also have to like a lot of these VCs, they have portfolio companies on their website, so you know the people they've invested in. So do your due diligence. Which investor is going to give you more hand-on support? Who is going to push you too hard? Who is going to just take the back seat? And it also depends on the kind of investors you're looking for. There are investors that are passive. It doesn't make them bad investors. And there are investors that are active. It doesn't make them good investors. So that's why you also need to do your due diligence on the kind of investors you're having on your cap table. And let me just say this, it might not be popular opinion, but at the later stage, maybe Series A, Series B, investors that would be coming in will care about the people that you have on your cap table. They will care about the people that are investing together with them in the company because there is reputation, right? So that's it.
Amazing. Thank you for breaking that down really well. We have about three more questions, and I think that will end at the third question, so we can round off before 8:30. So Amide is asking, and I want us to just answer these ones very briefly, so that we can just round off on time. She's asked, I'm not sure if it's he or she, I'm sorry, that is it advisable to bootstrap, have a job up to pre-seed stage to avoid FFF issues? What's FFF
Friends
issues?
and family, I think.
Okay. Family and friends for issues? Is that's supposed to be around? I mean, but do you understand the question?
I think so.
Yeah, I think the first part is quite clear. Is it advisable to bootstrap at your pre-seed stage? Yeah, would you want to answer that?
I these questions do not have one answer because if you're building an AI startup, then I don't think you can bootstrap. You need a lot of money,
Mm,
right? If you're building in a space that is very competitive, you can't
mm,
afford to go too slow. So you
mm-hmm,
need a lot of money. So it depends on the sector you're building in. There are some sectors that maybe there is limited competition, what you're trying to do. So even with little investments, you'll be able to get a lot of traction to then raise your pre-seed, then fine, go ahead. But there are actually some industries that you actually need the capital
mm,
to raise. And I also understand keeping your job because you don't want to be using business and you don't have, source of income as
mm,
well. So you can always keep your job if you know that you will be able to balance the two.
mm,
And I know that there might be worries about, I'm speaking with an investor, and the investor is worried that I have a job together with the business. So from what I've seen, from experience, a founder having a job while building a business is not a red flag.
mm.
The red flag is if after you get the investment, you leave the job.
Mm,
A lot of times it would be conditional precedents. So there's something called conditional precedents, and these are like things that you have to fulfill to get the investment. The investment is set in stone so far you fulfill those things. So I don't think so. The business is good. They have a reason to say no. They won't say no just because you have a full-time job. So far, you come to an agreement. Okay, once you commit, a firm commitment that you're investing, I'll leave my job and you disperse the fund. I see no reason why you should still keep the job when you're already a steward of somebody else's capital. So yeah.
Interesting. So, I think that so let's just take the last two questions really quickly. But to Ayomide, this person, I would just say for me, what I would advise is until you hit PMF, product market fit, keep your job, please, because that startup is not it's still hanging on one leg. So you might need that job to support, especially if you're a family person, you might need that job. So that's just a very good advice I wanted to share. Um, Rejoice is asking that for founders, first-time founders who have validated the ideas but are not experts in the field of startups, how do they gain credibility? Can joining an accelerator program help or getting an angel investor on board? I'm sure the question is quite clear. So let's try to round up before 8:30 so that we can just can you just take the question really quickly?
I'm trying to see the question. For first-time founders who have validated their ideas but are not experts in the field of this as well.
Hmm.
I think credibility. I think credibility comes from results.
Hmm.
I think nobody's going to deny your credibility if you're able to show results.
Hmm.
I mean, just like you said, you validated the idea. It means that you have results to show,
Hmm.
right? So there are times whereby, and that's why a lot of factors come into play. It's not just the idea. Sometimes it's the founder. So a founder can have, say, 20 years of experience in robotics. And if that kind of founder is saying that, oh, I have this massive idea in robotics that I think is actually going to be a hit, I will want to believe that person more than somebody that doesn't have any experience in robotics and say they have an idea. It doesn't mean that that person that doesn't have any experience in robotics will fail. It just means I need some form of credibility, and that credibility is going to come from results. So if you're able to prove to me that even though I don't have experience in this industry, I know for sure that this thing is going to work. I'll get somebody that has experience in the industry. We're going to build an MVP. It's going to be successful. Then I mean, the credibility is there already. Yeah.
Absolutely. I think just to add one more thing to that, I think I understand the nuance that the person is speaking from. Y Combinator, Techstars, and all of these different platforms, they add a layer of credibility to some companies, especially with regard to
Yeah,
receiving
definitely.
investment. So yeah, I mean, it can be a target for you to actually get into a Y Combinator or to get into a Techstars,
Yeah.
right? It can be a target to actually help your visibility and credibility. So yeah, just to add to what Tofumi said. And the
Even an
final
angel
question,
investor. Even an angel investor.
yes, an angel, exactly. An angel with very deep industry expertise and connections. The final question before we call it an evening would be what would make you reply to a particular founder? That is what will stand out for you. To for me, what will make you reply to a founder?
I think I reply to all founders, right? That's personal for me.
Mm,
Not everyone will respond, but I do. And it doesn't mean it's always good news,
mm,
right? And what would make me reply? Okay, so let me just say this. That when you're reaching out to me for with your deck, I am not making the decision from a personal point of view
mm,
because I am not an angel investor. So I'm making the decision from the company I work with point of view,
mhm,
from the investment thesis point of view. So
mhm,
if the investment thesis doesn't align, I will have to say no. Even if I personally love the business and if I had the money, I would want to invest,
mm.
right? So, so what would I think for the question, I respond to all. But what would make me like say, okay, let's get on a call is if I see an alignment between what you're building and the investment thesis. So yeah.
Amazing. I think this was very, very comprehensive and insightful. And I really did enjoy the session myself, right? It was a very, very interesting one. I don't know what everyone thinks. I mean, guys, leave your comments or leave emojis just to, react. Let's know what you think. We'll be ending the session very shortly. I will be calling up to the stage very briefly. Isioma, the CEO at Opolo Global. just to give her final remarks before we end. And once she's done, I'd like for all of us to, turn on our cameras. Let's just take a quick, right, what's the word now? Picture, right, just for everyone to see, and then we can, yeah. So Isim, over to you, and then we'll take the picture.
Okay, good evening, everyone. Thank you all for joining. I hope this was as insightful for everyone as it was for me. I know it's late in the evening, so I'm really thankful to the 40 something or so people who joined this call. The fact that you're here today, it just means that you're serious about the journey that you're about to take in fundraising and growing and scaling your business. And that's what we are all about at Opolo Global. I know that if you caught the beginning of the call, you got Joba talking about the business, what we do at Opolo Collective, and some of the programs that we have coming up. He's also talked about the She Skills program, which we've just launched, which is a 6-week program for female founders, tech enabled, who have some traction and are looking to raise VC funding. We have an exciting lineup of supporters, mentors, coaches as well that will take all the ladies through the program. And, at the end of it, what would really be interesting for us and what would really be a success story is some investor matching at the end of the day. I think we all know, and I'm just going to say this to just let you know that the men are not being marginalized here. Women are the ones who have been marginalized for years and years and years. And you will see the statistics, less than 2% of all the funding, the VC funding that is generated, that actually goes to women. The success rates are low. The value of the funding is also low. Women don't seem to raise as much as their male counterparts. So we're going to be hearing from women who've done it and done it well. And after this, we're going to open up a more generic, more sector agnostic, more gender agnostic actual incubation program for everyone, which would include both male and female entrepreneurs and founders as well. So again, thank you. If you haven't registered for She Skills and you're a woman and you meet the criteria, please do so immediately after this call because the spaces are filling up. And I really just wish everyone all the best on their journey. It's not easy, and we're here as a collective to support you on that journey. And I am sure also that there's a lot to learn from each other. So thank you to our able host, Joba. Thank you for our co-host and guest today, Tofumi. Thank you so much for obliging for free. Thank you. People don't do things for free anymore, so we're really grateful. Thank you everyone again for joining, and enjoy the rest of your evening.
Amazing. So can we just take a quick, picture? Everyone, can you just turn on your cameras? Emmanuel, I think you can put up Tofumi on the at the top. Can you pin Tofumi as well, Emmanuel? So we can just take a picture. Yeah, I think it pinned already. So I'm waiting for everyone's camera to be turned on now, so we can just take the screenshot. Thank you, everyone. We're really looking forward to having you. There's a lot more from where this came from, right? We have Opolo Collective, and yeah, so I think we should just say cheers as I take the picture now. Cheers, everyone. All right, so have an amazing evening. Thank you so much for your time on the call. Bye, everyone. And thank you
All
to
right.
Bye, everyone. Bye.